When currencies crash, gold gleams. Discover why the elite are quietly hoarding physical gold, Bitcoin, and hard commodities right now for the 2026 reset that most people still refuse to see coming. Stick with me for the next 2 hours and I'll hand you the exact blueprint they use. Welcome back to Wealth Architect. I'm Dr. Ben. This is the channel where we stop pretending the 10% Save Index Fund 40-year retirement lottery ticket is going to make you free. That system was designed to create loyal employees, not sovereign owners. Today, in episode 13, we are going deep, really deep, into the one asset class the 1% have always turned to when fiat money starts to break: gold and its modern alternatives. We're talking physical gold, Bitcoin as digital gold, broad commodities, farmland, timber, infrastructure, everything the family offices and central banks are actually allocating to right now in early 2026, while gold is trading above $5,000 an ounce, and central banks just finished their 4th straight year of record purchases. This is not another surface-level buy gold video. This is a 2-hour masterclass. By the end, you will have the complete historical proof why this works, exact step-by-step acquisition and storage instructions, portfolio construction templates the ultra-wealthy actually use, the psychological and emotional framework to actually follow through. If you're tired of watching your purchasing power bleed away and you want the same asymmetric protection the elite quietly stack, stay with me. Hit subscribe, turn on notifications, and let's begin. Let's start exactly where the pain is, because until you feel the problem at a visceral level, the solution never sticks. We just lived through the highest sustained inflation in 40 years. From 2021 to 2025, the US dollar lost roughly 23 to 25% of its purchasing power, depending on whose basket you trust. Groceries, rent, insurance, college tuition, everything moved higher and faster than wages for the average person. And in early 2026, the warning signs are not subtle. U.S. federal debt is now over $37 trillion and climbing $1 trillion every 90 days. Interest on the debt alone is larger than the entire defense budget. Central banks globally bought another 863 tons of gold in 2025, on top of the record years before. China, India, Poland, Turkey, Brazil, even Saudi Arabia are quietly reducing dollar exposure. Ray Dalio has gone on record again. The monetary order is breaking down. He still recommends 5 to 15% in gold or gold plus Bitcoin for any serious long-term portfolio. Historical parallels, this is where most videos stop. We go deeper. Weimar Germany 1921 to 1923. Hyperinflation, middle class wiped out in months. Gold preserved wealth for those who owned even small amounts. 1970s U.S. stagflation. CPI averaged 8.8% for the decade. Stocks went sideways in nominal terms and lost 60% in real terms over 15 years. Bonds were destroyed. Gold returned 35% per year compounded from 1973 to 1979. 2008 to 2011, quantitative easing, round 1, 2, 3. Gold went from $700 to $1,900. 2020 to 2022, pandemic money creation. Gold and commodities outperformed while bonds lost value. The psychological trap most people fall into, they think it can't happen here, or the Fed will fix it. The 1% don't think that way. They think in debt cycles, monetary resets, and currency debasement. They have already moved. Even if you do nothing else today, write down this number, 5%. If you simply move 5% of your liquid net worth into hard assets, historical data shows your portfolio's maximum drawdown during the next inflation surprise drops dramatically. That single move is the difference between panic and peace. We'll come back to exact percentages later. Gold is not an investment. It is the original money. For 5,000 years, it has survived the collapse of empires, wars, currency reforms, and political madness because it cannot be printed, cannot be hacked, and cannot be debased by a stroke of a pen. Deep performance proof. We're going slow so this sinks in. 1971 to 1980, gold plus 2,300%, while the dollar lost 60% of its purchasing power. 2000 to 2011, gold plus 650% during the first two rounds of modern quantitative easing. 2022 to 2025, while the S&P 500 and bonds suffered real losses, gold delivered the best risk-adjusted returns among major asset classes. Inflation-adjusted all-time high from 1980, around $3,590 today, was shattered in 2025. We are now in the next leg of the secular bull market. How the 1% actually own gold, the three-layer system they use. Step-by-step acquisition guide. This alone is worth the video. Decide on form. 1-ounce coins, American Eagle, Canadian Maple Leaf, Australian Kangaroo, South African Krugerrand are the most liquid and recognizable worldwide. Only buy from established, reputable dealers, APMX, JB Bullion, SD Bullion, or local coin shops with decades in business. Never Facebook Marketplace or random Telegram groups. Verification checklist. Weight and diameter must match exactly. Use a precision scale and caliper. Sigma Metalytics tester or ping test for large bars. Buy only coins or bars with assay certificates from recognized mints. Avoid numismatic rare coins unless you are a collector. Stick to bullion for wealth preservation. Start small, even 1 or 2 1-ounce coins this month, then add monthly. Dollar cost average into physical the same way you would stocks. Storage options ranked by security versus convenience. Home safe, fireproof, bolted to the floor for less than 20 ounces, convenient but not 100% safe against determined theft. Bank safe deposit box, cheap, but remember, in a true crisis, banks can be closed or restricted. See 1933 gold confiscation. Professional insured vaults, Delaware Depository, Brinks, Loomis, or international options like Singapore, Zurich, Dubai. Annual cost 0.25 to 1.5%, depending on size. Many offer segregated storage, so your exact bars are identifiable. Segregated allocated storage with full audit rights is the gold standard for serious money. Other indirect exposure options. ETFs, GLD and IAU track spot price, extremely liquid, can be sold in seconds. For accredited investors, allocated gold accounts at Bullion Vault or Gold Money, you own specific bars, stored in vaults, audited monthly. Gold mining stocks. Senior producers, Newmont, Barrick, mid-tiers, juniors, and royalty companies like Franco-Nevada, Wheaton Precious Metals. These can deliver 3 to 10 times the return of physical gold in a strong bull market, but they are volatile. Myths busted. Psychological block removal. Gold pays no yield. Correct, but neither does cash when real rates are negative. Gold's yield is purchasing power preservation. Governments will confiscate it. 1933 happened under very different circumstances. Today, the U.S. holds only around 8,000 tons. Confiscation is logistically and politically almost impossible at scale. Pause the video, open your brokerage or bank app right now. Look at your largest liquid account. Calculate 5% of that number. That single figure is your first gold target. Write it down. You just took the same first step every family office takes. We'll build on it later.
The elite now treat Bitcoin as digital gold with a 21 million hard cap and mathematically enforced scarcity. Ray Dalio, Paul Tudor Jones, Stanley Druckenmiller, and dozens of billionaires have publicly allocated. Key comparisons, side by side so you internalize. Gold, 5,000-year track record. Physical, no counterparty risk if held personally. Bitcoin, 15-year track record, digital, portable across borders, verifiable by anyone, but requires careful custody. 2026 institutional reality. Spot Bitcoin ETFs have over $150 billion in AUM. MicroStrategy, Marathon, and multiple public companies hold billions on balance sheet. Nation-states, El Salvador, Bhutan, and rumored others are accumulating. How to own it safely. The self-custody blueprint most people skip. 1. Buy on reputable exchanges, Coinbase, Kraken, Gemini, or OTC desks for larger amounts. Immediately withdraw to your own wallet. Never leave on exchange long-term. 2. Hardware wallet, Ledger, Trezor, Cold Card, plus multi-sig setup for amounts over $50,000. 3. Seed phrase storage, metal plates, not paper, split across multiple secure locations, never photographed, never digital. 4. 2 to 5% portfolio allocation is the sweet spot for most high net worth individuals right now. Higher volatility, but massive asymmetric upside in a continued monetary debasement environment. Risk mitigation, volatility, regulatory risk, technological risk. Solution: treat Bitcoin exactly like gold. Small, consistent buys, never sell in panic, hold through cycles. If you already own Bitcoin, comment the percentage of your net worth you have allocated. If not, write down your target, 2 to 5%. You are now thinking like the architects. Gold and Bitcoin are the monetary hedges. Commodities and real assets are the input cost hedges. When consumer prices rise, the raw materials rise faster. 1970s proof. Bloomberg Commodity Index, backtested, returned over 400% while stocks and bonds were crushed. 2022 example. Same index, plus 30+% while S&P and bonds fell double digits. Easy liquid ways to own them in 2026. Broad commodity ETFs, DBC, GSG, or the newer inflation-focused funds. Sector-specific, energy, XLE or futures ETFs, copper, CPER, uranium, URNM, agriculture, DBA, real assets, farmland REITs, FPI, land, timber REITs, WY, PCH, infrastructure funds, quality industrial and commercial real estate with inflation-linked leases, family office level, direct farmland via platforms like AcreTrader or Farm Together, minimums now lower, private timber partnerships or master limited partnerships in energy midstream. Strategic ordering the elite actually use, not theory, observed in public filings and family office reports. 50 to 60% traditional equities and bonds, but tilted toward real economy companies. 7 to 15% gold, physical plus ETFs. 3 to 8% Bitcoin or digital assets. 8 to 15% broad commodities and real assets. 10 to 20% private credit, venture, or other illiquid asymmetric bets. Historical backtests, 1970s, 2008, 2022, show this mix reduces maximum drawdown by 30 to 50% and improves real returns during inflationary decades. Rebalance once per year. Never panic sell the hard asset sleeve. The biggest difference between the 1% and everyone else is not intelligence, it's emotional control and time horizon. Common pitfalls I see. Buying at the top after a big run-up and selling at the first 20% dip. Putting everything in one asset instead of layering. Storing improperly and losing sleep. Treating this as speculation instead of insurance. Your 30-day blueprint. Write this down. Day 1 to 7. Calculate your 5 to 10% hard asset target. Open accounts if needed. Day 8 to 15, buy your first physical gold, even 1 ounce, and set up Bitcoin self-custody. Day 16 to 22, add broad commodity ETF and 1 real asset position. Day 23 to 30, set calendar reminder for annual rebalance. Read 1 family office report or Dalio book chapter. Imagine 2027. Inflation is running 8 to 12%. Your neighbor is selling stocks at a loss to pay bills. You open your statements and your hard asset sleeve is up 30 to 60%. Your purchasing power is protected. You sleep. That feeling, that quiet confidence is what the 1% buy with these allocations. You just bought the same insurance policy. If this 2-hour blueprint gave you clarity, confidence, and a real plan you can execute, do these 3 things right now. 1. Like the video if you're already stacking or starting this month. 2. Comment below with one action you're taking this week: gold coin, Bitcoin wallet, commodity ETF, or farmland research. I read every single comment. 3. Subscribe and hit the bell. Next episode, we dissect how the 1% use private credit and asymmetric off-market deals most people never see. You are not here to follow the retirement lottery ticket. You are here to design freedom. I'm Dr. Ben. I'll see you in the next blueprint. Stay sovereign.